Less than a week ago, there was a really good conversation, a discussion on Real Vision TV that they released between Danielle DiMartino Booth and Tracy Schuchart of Family Office Capital Benoit. If you are on Twitter, you probably know her more under her Twitter handle Chi Girl, CHI as in Chicago Girl. She covers the oil market. She's been a long-time trader. She's also done podcast interviews on Macro Voices and other podcasts. And the discussion was about the oil market. It was a very interesting discussion, but Danielle DiMartino Booth actually put out a really interesting chart. That chart you can see there on your screen about the Fed enabling the shale revolution. So this is a topic I've been talking about for over a year now. My thesis has been that a lot of these U.S. shale oil producers, although they have lowered their production costs, they have not consistently been profitable. They have not consistently generated free cash flow. A lot of them have not consistently generated positive returns for their investors, although some investors who are short-term oriented and funded some of these shale oil wells have done very, very well with short-term loans for the wells, for each individual well. But overall, U.S. shale oil has benefited the U.S. economy. It's caused an enormous amount of job growth in North Dakota, although now that's starting to go in reverse with the amount of capex cuts, massive capex cuts. I'll talk about the capex cuts exactly in a little bit. And massive job creation in Texas as well. Also massive investment in job creation as the Permian Basin now is the largest producing oil field. It is now outproducing Ghawar in Saudi Arabia because Ghawar is down. So cheap oil to the U.S. economy, it's benefited the U.S. economy extensively. It's benefited the U.S. consumer. There's been massive amounts of capex and capital investments compared to the oil industry in the rest of the world. The shale oil has gotten the bulk of the oil investments of the rest of the world, whereas really since I've been an oil and energy analyst, was my day job a number of years ago, full-time, and I worked with Robert Rapier, one of the best in the business. He just put out a very interesting article recently. I'll talk about that in a little bit. He's talking about some of the most important things that happened in the oil market this year. And the U.S. has benefited extensively from the investment into shale oil, as it's created a lot of jobs, a lot of capex investment, and also the cheap oil has benefited the U.S. consumer. It's prevented consumers from getting squeezed with higher oil prices, and that has allowed, on a relative basis, the U.S. economy to look better than a lot of other countries and their economies. So I highly, if you're a Real Vision TV subscriber, I've recommended Real Vision in the past. This interview may, if you want to watch it now, it's behind the paywall. If you wait maybe 2 weeks or a month or two, it'll probably be free because Real Vision is releasing these things for free. But I think Real Vision TV is worth a subscription. Not all the content is as great as this discussion, but I think this discussion was great. So the pension funds and the Federal Reserve, in my opinion, the pension funds, a lot of pension funds, a lot of capital subsidized shale oil because yes, they did. A lot of these shale producers did lower their production costs a lot. I remember when I was an oil analyst and I was looking through the production costs of a lot of these shale companies and the oil price was falling. The Saudis were refusing to cut oil production back then. This was 2013, almost 2014. When I was when I was doing this for my day job as an oil and energy analyst, the Saudis and OPEC were refusing to cut production. They didn't want to give up market share. That was one of the reasons. But most importantly, they did not want to move the oil price back up. They were trying to kill the shale oil producers. They were trying to kill them in the cradle. Because the shale oil producers back then, everyone thought, and I was reading the oil industry research reports, I was reading the comments from the best oil analysts, I was paying attention to all the analysis from the top oil hedge fund managers, and pretty much everyone, there was a consensus that the shale oil companies, their production costs were at the low of $65 a barrel, and a lot of them had higher production costs than that. However, they were able, over the course of a few years, a lot of them did not go bankrupt. They were able to lower their production costs. But most importantly, for many years, these shale oil companies were able to raise massive amounts of capital, just unbelievable amounts of capital, from pension funds, from private equity, and also from banks. And I believe the Fed was heavily involved in this. Zero Hedge did a story a couple years ago that the Dallas Fed still denies, and Zero Hedge says they had multiple sources inside the Dallas Fed leak them the information. Danielle DiMartino Booth has confirmed that the Dallas Federal Reserve pays very close attention to the Texas oil companies and what they announce for their jobs numbers and their oil production. And the oil production in Texas has massively exploded. The U.S. is now producing around 12.8 million barrels per day of oil, approximately. So we're not fully energy independent. We're still importing, I think, it's 8 million barrels per day, give or take, approximately. So the politicians and a lot of other people are going to say the U.S. is fully energy independent. The U.S. is still importing oil, but the U.S. has a massive amount of oil production. It's way up there. It might be the best right now because the Saudis are having some production problems with Ghawar. They've had the Saudi Aramco IPO, which was a success and probably being helped by the investment banks that are backing it. I wouldn't touch that thing with a 10-foot pole. If you look through the prospectus, I think the shareholders for the Saudi Aramco IPO, I think they have almost no rights. They have no voting rights. So they're just getting exposure to the oil company. So in the short term, the IPO may go up a lot, but in the long term, I have very serious doubts about the Saudi Aramco IPO and the valuation and how the shareholders don't have any rights. But also, we found out in the prospectus that was filed initially for the Aramco IPO that the production at Ghawar, which the Saudis claimed was still 5 million barrels per day, it was over 1 million barrels per day less. I think it's now down below 1 million barrels per day. I think it's 3.8 million barrels per day now. I think it's dropped. Robert Rapier just put out in his new article that a couple days ago for Forbes. He writes all over the place for oil and energy analysis. He also has a paid oil investment newsletter, which I helped write with him a number of years ago. Actually, he writes multiple ones for Investing Daily, but I worked on one or two of them. And he was talking about the oil production at Ghawar. Now, it's dropped so much that the Permian Basin is now outproducing Ghawar. So the Permian is getting lots of investment from ExxonMobil, Chevron. ExxonMobil claims that they're going to get double-digit returns on their investment in the Permian. We'll see. The Permian production growth has absolutely exploded. There's been lots of investment there in East Texas? Permian East Texas or West Texas? I can't remember offhand. Tori Johansson says, any thoughts on the energy return on energy invested phenomenon? In the short term, it does not matter. Just like how in the short term oil inventory matters, in the long term, the oil inventory numbers here in the U.S. do not matter. So energy return on energy invested, I could make a good argument that over the last 10 years, the Federal Reserve and the pension funds here in the U.S. have papered that over. So the energy return on energy invested for 10 years did not matter. It was subsidized. Oh, the large oil and gas companies are getting killed on their natural gas investments. I covered that recently in the last week or two. There's massive write-downs already from Chevron. There's been a few other larger and independent oil and gas companies with massive write-downs. I think it's over $20 billion already this year in natural gas write-downs. And a lot of analysts think that ExxonMobil will have to write off up to $30 billion of the full XTO energy acquisition, which they paid for at the top. So the oil price has rallied quite a bit in the last 3 months. Take a look at the chart here. At the beginning of October, we had WTI crude in the low 50 range, around $52, $53 per barrel for WTI. As of right now, when we're doing this live stream show, it's over 60 at $61.73. Brent crude 3 months ago, Brent crude was at 58, 57 and $58 a barrel at the beginning of October. And Brent crude's now at 66. So WTI has rallied more than Brent on a percentage basis. Brent is up less than $10 a barrel in the last 3 months, and WTI is up right around $10 a barrel. A little under, just under $10 a barrel. So WTI on a percentage basis has moved more than Brent. Now, this oil price is still low enough to where it's not going to hurt consumers. So the U.S. economy is still benefiting. The consumer is still benefiting from cheaper oil prices compared to other countries. We are getting more professional investors like Hedgeye, Keith McCullough, and his analysts over at Hedgeye. He had a very interesting interview with an oil money manager, I think Mark Gordon, in the last month or so. And then Peter Lynch, there was a really long article in Barron's, where they interviewed Peter Lynch in the last couple weeks, and he was talking about he was looking at oil companies that had good balance sheets that he thought wouldn't go bankrupt if oil prices went lower in the short term. And Jesse Felder just put out an article a couple weeks ago saying it's time to get greedy in the energy sector. So we have people who are buying oil companies now. I don't think all oil companies are created equal, in my opinion. It's definitely a stock picker's market. I'd be very careful here because, as they discuss in the interview on Real Vision TV, the discussion with Danielle DiMartino Booth and Tracy Schuchart, there's a lot of problems with a lot of these shale oil producers. A lot of these shale oil producers have an absolutely enormous amount of debt maturing in the next, I think, 5 or 6 years. There's over $100 billion in debt maturing that either needs to be rolled over or paid off. And the amount of capital available to a lot of these shale oil producers that was available by private equity, that was available by pension funds. I would call pension funds, unfortunately, for a lot of Americans, dumb money. A lot of pension funds that subsidize shale oil and did not get good returns on it will have enormous losses on their shale oil investments if they don't already have it. I think the amount of junk bonds, there's been over $1 trillion in shale oil junk bonds, but I think only about 27% of the shale oil junk bonds are in trouble right now. So that obviously could get a lot worse going forward. Danielle DiMartino Booth has been talking about that in the last couple weeks. So energy return, Tore Johansson, energy return on energy invested. We've gotten, especially here in the U.S., we've gotten a bailout or a subsidy for 10 years, at least 10 years. And depending upon how much more the Permian can grow oil production. There's people out there that think the Permian can continue to grow oil production pretty substantially for the next 5 to 7 years at least. Some people think it's more than that. But the data that we're seeing from the Eagle Ford Shale and the Bakken is not good. So the Eagle Ford and the Bakken look about tapped out. The ability to grow production massively in those two fields, not looking good. There would have to be $100 a barrel oil, and the reversal in capital, the reversal in capex would have to do a total 180. And industry-wide, I want to stress this point. So normally, I've talked at length about this in my mining stock education lectures, and if you're an investor in natural resources, whether it's an oil and gas company or a mining company, you need to understand capex, maintenance capital or capital expenditures or growth capex. You need to understand what both are and the differences between both. And when capex gets cut, that normally means for the local economies, that means a lot less jobs, or people are going to be asked to take pay cuts. But it also means that the ability to grow production for oil production or natural gas production or gold or silver production or copper production, the odds just drop. That the miner cannot make any investments because they're not generating free cash flow. They're just trying to survive. So normally if a mining company has to cut capex and there's problems, they cut exploration, they cut growth capex, they cut maintenance capex to the bone, and they may even sell assets for either whatever they can get for them, or they'll sell their best assets first, like what Yamana Gold did with Chapada, the producing copper and gold mine with the best margins, because Yamana could not afford a $220 million approximately upgrade at the mine. So they'll sell that first because they got the most premium, the best price for that asset, even though it was their best cash flow, best margin asset. So the oil industry, industry-wide, the oil industry has had massive capex cuts. I remember 2015 and 2016, the figures that were coming out about the capex cuts back then were many hundreds of billions of dollars after oil started correcting in 2013. So there was hundreds of billions of dollars in capex cuts back then. And oil, industry-wide, the amount of capex cuts is absolutely massive. I would say since 2013, there's been over $1 trillion in capex cuts industry-wide. Now, the one trend that has bucked is the Permian Basin. So the shale oil has gotten the majority of the capex in the last 10 years compared to all the other oil projects globally. Now there's some deep water projects off the coast of Africa, I think the western coast of Africa, but the majority of oil projects have not gotten the capex that they needed to get. And the majority of the capex that was actually spent went into the shale oil production basins in the Eagle Ford, the Bakken, and especially the Permian Basin now, which is the money still flowing in like crazy into the Permian, apparently, like many billions of dollars per year. But the rest of the oil industry, especially the national oil companies are so bad, most of them, with allocating capital and capital investments. And this is because the governments that run these national oil companies just see the national oil company as a piggy bank. So normally the governments, whether it's Venezuela or Mexico or many of these other governments that have a national oil company, they do not allow the national oil company, to make prudent long-term investments and to invest enough money into exploration and to upgrade their property, plant, and equipment and to upgrade their refineries. This just doesn't happen industry-wide. The Marcellus Shale, is the Marcellus Shale next to the Eagle Ford? The shale is that the natural gas shale? The Marcellus, the natural gas shales are all having problems. The Appalachian Shale, is the Marcellus Shale the Appalachian Shale? That's Pennsylvania? Oh, that's where the capex cuts are, Jay. There's going to be if there's not already, there's going to be a lot of job losses there. So people are going to be asked to take pay cuts if they want to keep their job, or they're going to lose their jobs entirely. Yeah, that's where a lot of the write-offs are. Many billions of dollars in write-offs. So Robert Rapier wrote a great article a couple days ago, and he actually said that BP Statistical Review, which is the largest, most comprehensive oil and energy report that comes out every year by BP, and he actually said that the demand for oil globally actually increased. It had a pretty large increase. Let me pull up that part of the article here. Let me see if I can get to it. The perception has affected oil markets that demand is falling, that they now seem relatively impervious to news that would have sent oil prices skyrocketing a decade ago. My reality is that the demand side of the equation for oil remains strong. When the BP Statistical Review was released in June, it showed that annual oil demand had grown by 1.4 million barrels per day year over year. That was a 1.5% gain to a new all-time high, was ahead of the 10-year average of only 1.2%. Demand growth has been slowing. Most of that demand growth is coming from other countries outside the U.S. and in the developing world. Probably China and the developing world. Even though auto sales are down in China, there's still a lot more cars driving on the road in China compared to, 5 years ago or 10 years ago. Demand growth has been slowing somewhat lately, but the International Energy Agency projects that 2019 demand grew by 1 million barrels per day, and 2020 demand growth will be 1.2 million barrels per day. But U.S. shale oil production has been expanding at a faster clip than demand growth, and that's what's really driving the ambivalent oil markets. So I think, I don't like British Petroleum, Gloob, but honestly, I think the BP Statistical Review is the best data set out there. It's very extensive. And most of the top oil and energy analysts I've interviewed over the years, and I've interviewed most of the best ones, pretty much all of them. It's all in the archives. I've interviewed dozens of them in the archives. Robert Rapier, many others. Dr. Kent Moores, many others. Eric Townsend, many others. Jim Poplava, and they all look at that report and think it's pretty accurate. So I'm not as bullish as Hedgeye and Keith McCullough. Well, Keith McCullough runs Hedgeye, and Jesse Felder and Peter Lynch on the oil industry. I think maybe in the short term they could go up a little bit, but there is a very, very big overhang with the amount of debt the shale oil companies have coming due in the next couple years. And so if you're long a lot of these shale oil companies, their balance sheets are going to play a major part. So if you pick out this is just my opinion, not financial advice. If you pick out the wrong individual shale oil company, you could get burned very, very badly. Because there's so much debt that has to either be rolled over or refinanced or restructured out of bankruptcy. But eventually, yes. So in the interview, the discussion with Danielle DiMartino Booth and Tracy Schuchart, they showed some charts like this, talking about the amount of shale debt that needs to get refinanced and how there's not as much capital available. And Tracy Schuchart, who studies the oil markets daily, she thinks that it's going to probably be another 2 years, maybe 3. She said 2021 before the oil market really starts to rise again. And she thinks, and my thesis is this as well, that there will have to be more bankruptcies in the shale oil company. Because as long as the oil production for shale can continue to be subsidized, but to a lot lesser extent that's happening now, because the other shale oil fields like the Eagle Ford and the Bakken, they're not massively growing production anymore. A lot of those wells are in major decline. So energy return on energy invested has not mattered in the last 10 years, largely because, in my opinion, pension funds and the Federal Reserve, there's a lot of evidence of this, have papered over, I would say, uneconomic oil projects to increase oil production. Now, this is not sustainable long term. You can't throw hundreds of billions, if not trillions of dollars, and get pension funds to subsidize hundreds of billions or trillions of dollars in bad investments without pension fund managers getting fired, pension funds getting sued, pension fund managers getting sued, etc. So this trend is not going to continue because the investment returns, the dividends that were promised, the free cash flow that was promised for shale oil has not. They've been promising every year for 10 years now, a lot of these shale companies, that they were going to have free cash flow and dividends. And some of these shale companies have actually done a good job surviving. They've cut their costs a lot. Some of these shale companies cut their costs from between $60 and $80 a barrel. They cut their costs down to 50 or a little bit lower than 50. So they've done a halfway decent job figuring out how to cut costs to survive. But they're not efficient enough to generate free cash flow consistently. And shale needs enormous amounts of capex to maintain or increase production. The amount of capex shale needs is absolutely enormous. No, I've been saying that the Fed has been backstopping shale. Rob Kirby was saying that the spike in oil prices is what caused the repo. I've been saying that the Fed has subsidized shale for a couple years now. And there was that story that came out a few years ago. I want to say it was 3 or 4 years ago, with the Dallas Fed and Zero Hedge were going back and forth. Dallas Fed called Zero Hedge a liar. Zero Hedge said they had at least 1 or 2 sources inside the Dallas Fed that confirmed that the banks that gave out loans to the shale companies were told not to call in bankrupt loans. Jesse says electrification can reduce demand. Not in every country. Not every country is going electrified. Going electric vehicles. Okay, the Eagle Ford is in East Texas, and the Permian is in West Texas, I guess. The amount of capital and credit that the shale oil companies got for the last 10 years, actually 11 years, has papered over energy return on energy invested. That will eventually matter again. I'm not long any oil stocks right now. I've been waiting for a bust, so I did not get this rally. I'm still worried about all that debt that needs to get refinanced. Because these shale oil companies cannot raise capital. Some of them can raise some capital, but nowhere near the levels that they need to raise. Okay, so I got 2 super chats here. Thank you, Ron. I appreciate it. Thanks for your hard work, Ron says. You're welcome, Ron. Ron asked, do I think there will be QE4 next month? Good question. So now we're going to go into the repo. I really didn't want to talk about repo, but since you gave me a super chat, I'll just briefly talk on it. So Zoltan Pozar, who is considered one of the best repo experts, he has said that despite the Federal Reserve announcing new term repos, increasing amounts of overnight repos, an emergency December 31st $75 billion repo. In spite of all that, and the last press release a couple weeks ago, 2 weeks ago, which committed an extra $220 billion approximately in repos, he said in spite of that, which now brings the total to around $500 billion in repos if you add in the Fed's not QE $60 billion per month, that in spite of that, he said it's nowhere near enough. And he said that the Federal Reserve cannot drug the repo market, similar to what Jim Bianco is saying, and that eventually in the next couple months, the Fed will have to do QE as well. Now, all these regular Wall Street people, these mainstream Keynesians, these mainstream financial professionals, these mainstream egghead economists are all now turning on Zoltan Pozsar for saying that the Fed has to do more QE. But I can tell you, because I've read their comments on Twitter, that a lot of these guys that are attacking Zoltan do not understand any of the things that are happening in the repo market. Absolutely none. They understand nothing about what's happening in the repo market. But they have the Fed's back. So they're just defending the status quo. They're defending the Federal Reserve. That, okay, the Fed announced these press releases and the Fed knows what it's doing and the Fed has everything under control. Meanwhile, we just got a news story that came out in the last 24 hours. The head of the Atlanta Federal Reserve admits that they don't know what they're doing with the repo market, and it's all trial and error, which is what I've suspected. The more I study what's going on in the repo market and listen to other experts talk about it, and the research reports that have been coming out about repo from the non-egghead mainstream economists, the non-Keynesians, the more I'm convinced the Fed still doesn't know what it's doing and still doesn't know what's broken in the repo market. IBJI says you can't knock Zoltan. It's like knocking Einstein. Well, I think they're turning on Zoltan because even though he worked at the Treasury Department in the New York Fed, the fact that he's criticizing the Fed and saying the Fed doesn't know what it's doing and is going to have to do more, that threatens the system, threatens the status quo. And anyone who threatens the system or criticizes the system or criticizes the status quo, they're going to get knocked down a peg or two or three. Stalemate IB says the Fed can't possibly have it all under control. It's trying to plug all up the holes. Yep. Well, Jim Bianco says that they've drugged right now the repo market into submission. But there's so many problems. There's at least, I've studied this hours. I didn't read all the research reports, but I've listened to experts who wrote them in podcasts for an hour long each one. And they summarize the research reports in the podcast interviews. I talked about this on a live stream show a few days ago. And from what I can tell, there's at least 2 or 3 really, really big problems that are connected to the repo market. Really, really big problems. I don't want to go into it now because this is not a repo show. So I think, Ron, eventually, the timing of this doesn't matter for QE4. I don't care about timing. The timing doesn't matter to me. I'm not a short-term trader. But yes, eventually we'll have to go to the pace, Ron, the pace that we're already on now with not QE and Repo Madness being added to the Fed's official balance sheet and MMT Light the last 12 weeks, according to Daniel Amerman in his newest article. I suggest you read Daniel Amerman's newest article on his website. He did a video about it a couple days ago. The pace that we're on now, we're on over $100 billion per month pace now. So yes, the Fed can do QE. Zoltan says it's nowhere near enough what's happening now, and we're already on a pace that's $100 billion per month, which is more than the QE2 and QE3 programs, the official QE2 and QE3 programs. So the Fed's not QE, and whatever's been added to the balance sheet from Repo Madness with the term repos per month on an average in the last 4 months since the end of August is an already larger pace per month, the last 4 months, than QE2 and QE3. Now, the Fed's balance sheet is not back to over 4.5 trillion yet, but on the pace we're on, that's going to be under 4 months. It's almost up to 4.3 trillion. The Fed's balance sheet's almost up to 4.3 trillion now. So in a week or two, it could be over 4.3 trillion. Jesse says the market loves not QE. Yes, all that fiat currency and credit has to go somewhere. And it's not just the US doing it. Japan's doing it. The European Union is doing it. China's doing it. It's going to end up somewhere, which means asset prices. I did not see the hedge funds shutting down. But these central banks are all hedge funds now. The largest hedge fund is the Swiss National Bank, but you have these central bankers bragging in Bloomberg and elsewhere, whether it's the Reserve Bank of Australia bragging that they do like currency and bond trades on Japanese yen and other currency trades, or Japanese central bankers bragging that they buy U.S. treasuries because on a relative basis it has higher yield than in Japan. So you have these central bankers acting like hedge fund managers. So they're creating currency units out of thin air. They're doing leverage trades, and they're literally gambling on other countries' foreign currencies, on the currency exchange rate. They're gambling in stock markets, foreign stock markets, and foreign bond markets. And the Swiss National Bank is probably the worst one because in only 3 years they ran a euro peg and they created hundreds of billions of dollars out of thin air running their euro peg, and then they took that hundreds of billions, which their companies did not have to work hard for at all, and they created all that capital and started a hedge fund with it and started buying up American stocks. So I think that's about it for this short live stream show. I was trying to keep it under 30 minutes. So I think the evidence is, you can see here on the chart, that this chart, Danielle DiMartino Booth, Quill Intelligence, she pulled, and you could see a pretty good correlation there between when the oil price started, U.S. oil production started to rocket a lot higher, and the Federal Reserve's balance sheet started to take off during the 2008 financial crisis. But we've reached basically a wall now because all the low-hanging fruit in shale is now gone. The Bakken and the Eagle Ford and the natural gas shale first of all, the natural gas shale assets at the current price are uneconomic and toxic. So you have enormous write-downs on the natural gas shale assets. But the oil shale is not getting the returns it used to. All the low-hanging fruit is gone, despite the production costs for those wells coming down, because more and more capex needs to go into those, more capex investments, and that the amount of capital is not available at anywhere near the levels that it was 5 years ago, 7 years ago, and 10 years ago. So I think it's very clear that the U.S. economy has benefited in a number of different ways, whether it's jobs in North Dakota or Texas from all the capex investment there from shale, or from the U.S. consumer getting cheaper oil than the oil prices in other countries. The U.S. has benefited extensively from the Federal Reserve and pension funds subsidizing shale oil production for the last decade. But this has only been 10 years. This cannot keep on forever because the cost of subsidizing these companies is astronomical now. And the bill's about to become due with all this debt that needs to be $100 billion for uneconomic shale companies with bad balance sheets that cannot raise capital. So that debt needs to be rolled over. It needs to be paid off, which is very unlikely. Some of it will be rolled over. Question will be how much and on what terms. And then ultimately either bankruptcies and restructurings or buyouts, where some of these shale assets are bought by some of the larger oil companies, but don't expect big premiums on those, in my opinion. I would expect assets to be bought for little or no premiums or pennies on the dollar. Daniel says shale is a petrodollar propping scheme. You may be right. You may be right, and that may also be another reason why the Federal Reserve helped subsidize the shale boom or the shale bubble, depending upon how you want to think about it. Okay, well, that's it for tonight's show. I want to thank you, I want to thank my over 200, I think it's over 230 now, Patreon account contributors. Moving on to 250. Hopefully it will be at 300 in less than 12 months. My dozen or so monthly PayPal contributors, and people throw me tip once in a while. So I can focus on research, content, information, and analysis like this in the financial education space.